You spent the last 30 years building up your 401k, thinking you're going to sail into retirement and then you're going to leave a nice little financial legacy to your adult children as a gift. But instead, you might be handing them a massive tax bill. Thanks to some changes in the tax law in 2020, your beneficiaries cannot stretch their withdrawals over the course of their lifetime anymore. They must be distributed over the course of 10 years. This is what I like to call the death tax trap of 401ks. And if you're not planning for it now, you might regret it later. Let me show you what it is and how to avoid it. So I hear some kind of variation of this often, which is, you know what? I've worked hard. I've helped my kids during their lifetime. I've worked hard for my retirement. My kids will inherit the 401k and they're going to be fine anyways. I'll let them worry about taxes. But listen, in 2020, when the Secure Act 1.0 came into law, this changed the game in terms of what accounts you should be spending in your retirement versus which accounts you should be leaving as a financial legacy. So before 2020, inherited IRAs could be stretched out over the course of the beneficiary's life expectancy. But after the Secure Act 1.0 passed, those accounts must be depleted at the end of the 10th year, which accelerates the amount of income taxes those heirs will be paying. And for many Americans who might have a couple $100,000 or $300,000 saved in a 401k or an IRA, that's not going to be a huge tax burden if you spread that out over the course of 10 years. But for the clients we serve and for all of you that are watching this video, PFR Nation, many of you have accumulated 1 million, 2 million, 3 million or more in 401ks, the majority of which are in tax-deferred vehicles, and those accounts will continue to grow even after you start taking those required minimum distributions. And when those accounts are passed down, your adult children at that point might be in their peak earning years, which really might accelerate the taxes that they pay on that financial legacy. So today we're going to look at an example of Jack and Barbara who have most of their funds in tax-deferred vehicles and how this plays out from a tax perspective during their lifetime and also at death. And then we're going to talk about things that they should consider in order to minimize the tax bill for their heirs. So as you can see with Jack and Barbara, like most of the clients that we serve that are about 60 years old, they're approaching retirement, or maybe they've recently retired, the bulk of their funds are inside of the tax-deferred vehicle. Okay. For this particular couple, they also have some assets in the taxable brokerage account, the taxable bucket, about $176,000, but $2.1 million, or about 92% of their overall investable portfolio, is inside of these tax-deferred vehicles, which is not necessarily a bad thing. And for this particular couple, Jack and Barbara, they've been in high income years for the better part of their career. So therefore, it actually did make a lot of sense for them to take those tax deductions for those contributions, defer those taxes, and then once they get to retirement, then come up with a withdrawal plan and a conversion plan in order to minimize their lifetime tax bill. And for them, they have Social Security, but they also have some pension income that they're going to rely on. So as you can see, the pension income will be a nice little bridge until they get to Social Security, which their game plan initially is to start at full retirement age. And so at full retirement age, as you can see, when that starts at 67, a good chunk of their income needs are being covered by guaranteed income sources from their pension, from their Social Security payments. And then that following year, this is when Barbara's also going to begin collecting her Social Security payments. So now we have Jack and Barbara both collecting their full retirement age Social Security, and the majority of their cash flow needs are being covered by those guaranteed income sources. But what you'll see is once they hit 75, right here, this is when RMDs kick in, or required minimum distributions. This is the current age, the beginning age in which everyone, regardless of what type of retirement plan you have, it's an IRA, 401k, TSP, 403b, 457, 401a, you're going to need to start taking required minimum distributions from those accounts. Roth accounts are the only ones that do not have required minimum distributions. So if you have the Roth version of any of the things that I just mentioned, those do not have required minimum distributions because you've already paid the taxes on those contributions and you're enjoying tax-free growth. So the IRS, they have no urgency to necessarily get those funds out of your pocket and into theirs. However, tax-deferred accounts do. And that's the point in time in which required minimum distributions kick in, is age 75. And as you can see at that point in time, the savings withdrawal jumps up substantially. Not because this particular couple needs that distribution. In fact, as we already pointed out, the majority of their cash flow needs are being covered by those guaranteed income sources, but those required minimum distributions must be satisfied. Otherwise, you're going to be hit with a 25% tax bill. So those RMDs will actually push them into a different tax bracket, which we'll look at in just a second. But as you can see, during this bridge period from retirement 62 roughly to about 67, they have a bridge period in which they're going to need to more aggressively withdraw from their portfolio. In this case, though, it's a pretty reasonable amount. It's hovering just under 4% there, and then just over 4% in that last 3 years of that bridge period. And then when Social Security kicks in, then the rate of withdrawal drops to about 2% once Jack is on Social Security. And then once Barbara takes Social Security, now the rate of withdrawal actually drops to 1% and even below. So what are we looking at here? We're looking at a potential increase in their taxes during their lifetime. This is why I did a video on the tax trap of traditional 401ks and IRAs. And I'll link that video after this one. But ultimately, if you look at this, Jack and Barbara, if they coasted, if they retired, they're like, hey, this is the lowest tax bracket we've been in our entire life. We've gone from the 22, 24% bracket. Now we're down to the 10% bracket. And then it jumps a little bit. Once they start to rely on some of those traditional IRAs and 401ks a little bit more, it drops, or it goes up to about 12%. But even still, this is the lowest bracket they've been in quite a long. And if they just continued on, they're going to be in a very low tax bracket for a number of years, more than a decade. Or once they turn 75, that's when those required minimum distributions kick in. And that's when their tax bracket is going to jump, in this case, up to this 22% level. So for them, one of the things that they could do to mitigate that potential tax trap is look at a Roth conversion strategy to potentially fill up some of those lower tax buckets. Maybe it's the 10%, maybe it's the 12%. Okay, maybe it's getting a little bit more aggressive, even to the 22% bracket, in order to minimize the impact of that 401k tax trap that we mentioned earlier. And especially if, let's say, one spouse has more longevity than the other, significantly more. Maybe one spouse has a health issue or a diagnosis that's going to prevent them from having any sort of longevity. And so therefore, the surviving spouse may have years, if not even a decade plus, as a single taxpayer. Well, as you can see what happens, we assume to both have longevity up until age 90. Okay, but as you can see what happens at that point in time, when Jack predeceases Barbara, her tax bracket actually jumps up to 24%. And that's because at that point in time, she'll be filing as a single taxpayer. Even though cash flows and income sources didn't really change a ton, the tax bracket went up because tax brackets are just simply less favorable to single taxpayers than they are to married couples. But this right here is what I like to call the Roth conversion window, is that period of time at retirement when your tax bracket drops up until you hit that required minimum distribution age, where if Roth conversions make sense for you, this is when you want to get aggressive with those Roth conversions in order to minimize the tax trap of these 401ks and IRAs. And this actually illustrates this really nicely, this particular chart. As you can see, 2037 is the last year in which they are not required to make any distributions. And as you can see, the amount that they're withdrawing from their tax-deferred account is only $23,684 because this satisfies their income needs to supplement their pension and their Social Security income. However, that following year, when they are starting to take those required minimum distributions, all of a sudden their distribution goes up from $23,000 all the way up to $145,000 that year, which is just under 4% of the account balance is what those required minimum distributions will start at. And then over time, they will continue to go up because of two factors. Number one, potentially you could continue to experience market growth in excess of the amount you're withdrawing from your portfolio. So if you were withdrawing, let's say 4% from your portfolio to satisfy RMDs, but then you're earning, let's say 6 or 6.5% on your portfolio on those IRAs, the account balance will continue to go up, and that impacts the amount you're required to take out the next year. Additionally, your life expectancy factor goes down. So the life expectancy factor impacts the amount you have to take from your portfolio each year. So as you get older, the life expectancy factor goes down, and as a percentage of your portfolio, you're required to take out a higher amount each and every year. So those two factors together, essentially you'll see those RMDs will continue to grow throughout their life expectancy. And at 85, they started with just over $2.1 million inside of their IRA at roughly 62. 23 years later, not only did they retire, they've been retired for 2 decades plus, but their portfolio also grew. And now their portfolio balance on the tax deferred side grew to about 3.8 million. Additionally, the taxable account also increased. And the reason is because they didn't need all of these cash flows from those RMDs. They didn't need all the cash flow. So what they were doing is they were taking any surplus cash flows and they were investing it into the taxable brokerage account, invested at a reasonable rate of return. So that account will also continue to grow over time. And this is actually one of the more favorable buckets that you can leave to your heirs. You pay the taxes, you reinvest it into the taxable brokerage account, and upon death, at least in today's law, those assets will be inherited by the next generation, and they will receive a step up in the cost basis. So they could pay little to no taxes if they decided to fully liquidate that inheritance when you pass on. So taxable brokerage account, one of the most tax efficient vehicles to leave as an inheritance. But the tax deferred bucket will continue to grow during their lifetime. And as you can see, this $3.8 million, if this is spread out over the course of, let's say, 10 years, let's say both Jack and Barbara passed away at 85, all of a sudden, if you divide this simply by 10, you have about $380,000 on an annual basis that your heirs are distributing from that IRA to satisfy that 10-year rule. Now, it doesn't have to be like that. They can take a little bit more on the front end, a little bit less on the back end, depending on the age in which you pass away. But ultimately, they can fluctuate their withdrawals just a little bit depending on the timing of cash flow. So maybe hypothetically, in the first 5 years of them in that 10-year window, that 10-year rule, maybe they're still in their peak earning years, and maybe they actually withdraw just the minimum from the portfolio, the minimum from that IRA, and then after 5 years, they're expected to retire, and then their tax bracket goes down, then they can get a little bit more aggressive with those 10-year withdrawals. But if you just sort of use the basic back of the napkin calculation, we're talking an additional income on average of over $380,000 per year. And I say over 380 is because we also will expect for this portfolio to continue to grow. So we're talking probably closer to about $400,000 a year on average over the course of that 10 years that your heirs are going to have to pay taxes on. Now, just for fun, one of the things to mitigate this and to really think about the death tax trap of these 401ks and IRAs is looking at, okay, what if they did some Roth conversions, okay? Again, if it makes sense in your financial plan, if this is important to you, if you weigh the pros and cons of the conversion, if it aligns with your long-term plan, you may consider Roth conversion. So just for fun, what we wanted to do is we said, hey, you know what? What if we targeted conversions beginning when Jack retires up until he turns 80, and let's assume instead of filling up a tax bracket, because we could assume, a 22% or 24% tax bracket, one of the things that they do not want to do is they do not want to pay any additional surcharges for Medicare. That's what this is. This IRMA, it stands for Income Related Monthly Adjustment Amount. And so this is essentially a surcharge or an additional tax paid if your modified adjusted gross income goes above certain tiers. And there are 5 different IRMA tiers. So in this case, we wanted to say, hey, what if we did not want to pay any IRMA? Let's fill up that amount of income, that amount of adjusted gross income, and let's assume hypothetically that their son is in the 24% tax bracket, which they may be currently, but we'll talk about the impact of those 10-year withdrawals in just a second. So maybe their son is doing pretty well, he's single, but he's in the 24% bracket, and they're looking to convert at the no IRMA bracket, which is in that 22%, but not maxing out that 22% bracket. The impact there is Jack and Barbara saved $134,000 in lifetime taxes during their retirement years, but also they actually increased their tax-adjusted assets by about $181,000. What this means is if you compare their ending balance sheet, their ending investable portfolio, before conversions versus if they implement this conversion strategy and filling up that IRMA tier, that amount of modified adjusted gross income before IRMA is triggered, they would have increased their ending after-tax portfolio value to their son by about $181,000. That seems like a pretty good deal, especially considering when you do the conversion, you're actually paying more in taxes today. So yes, longevity is on their side. We did assume some longevity in their family for this particular couple, and that absolutely does play in favor of doing Roth conversions, particularly to solve the death tax trap of these 401k plans. But as we just pointed out, their son is currently in the 24% bracket. He's doing well. Let's say he's making $150,000, hypothetically. Let's say he's making 150K. So he's doing well and, he's humming along. But hey, you know what? If he all of a sudden inherits $3.8 million IRA and he's looking to satisfy that 10-year rule, we just mentioned he's probably going to be generating an additional $400,000 on average of taxable income. Okay, that's going to be added on his tax return. So if you add $400,000 hypothetically, that all of a sudden pushes him into that 35% tax bracket. So again, Jack and Barbara were converting around that 22% bracket. And then when they pass on, then those assets are then distributed potentially at a higher tax bracket, depending on how much they converted during their lifetime. So here, same thing. We want to target conversions beginning at Jack's retirement up until 80. And also we do not want to trigger IRMA, income related monthly adjustment amount. And by the way, IRMA is a 2-year look back. So if you're looking at doing a conversion in 2025, that's going to show up on your IRMA calculation for modified adjusted gross income for 2027's premium. But now the only difference is instead of their son being in that 24% bracket, which is back of the napkin math, probably makes sense given his income and his current situation. But all of a sudden, if he inherits that IRA and he's following that 10-year rule, now he's going to be pushed into the 35% bracket. And if you look at the impact, same thing. Jack and Barbara doesn't impact their lifetime taxes paid. They still are doing the same amount of conversions and they're saving about $134,000 in lifetime taxes paid. However, what you'll notice here is the tax adjusted net worth or ending investment amount has actually increased $415,000 as opposed to $181,000. So this is what we're talking about with the death tax trap of these traditional 401ks and IRAs is you don't necessarily need to look at your kid's tax bracket today, but your kid's tax bracket, including the potential inheritance that you might leave them in these tax-deferred vehicles. So just a few final thoughts. The first and foremost is when you're considering whether or not to do a Roth conversion, you need to not only think about your lifetime tax brackets, but also the potential tax brackets your kids are in today, as well as what they will be in if they were to inherit a large IRA or 401k from either you or your spouse. The second thing you need to do is if you decide that Roth conversions fit within the context of your overall plan, you need to identify when is your Roth conversion window. Okay, typically your Roth conversion window is going to be when you retire and that earned income goes down next to zero or close to zero up until you start taking those required minimum distributions from those IRAs and 401ks. And even better yet, before you start taking Social Security income. The third thing is if Roth conversions make sense and you've identified your Roth conversion window, now you need to figure out which bracket are you going to target? Are you going to target the 10%, the 12%, the 22 or 24? Okay, I don't see a lot of scenarios where targeting the 32, 35, or 37 makes sense, but it could, depending on how large your 401k and IRA is, and then how high of a tax bracket your heirs are in already. And then you need to decide how long you might continue those Roth conversions. Are they going to be up until you turn 75 and start taking required minimum distributions? Are they going to be indefinitely throughout your entire life until you've converted all of those assets to Roth? That may or may not make sense depending on what some of your legacy goals are, as well as your long-term care plan. But you need to decide how long those Roth conversions will continue for. And then lastly, you need to decide which accounts are going to be best left to your heirs versus which accounts are going to be best for you and your spouse to spend down during your lifetime, during your retirement years. Now, if you're in a position where you're like, hey, you know what, Kevin, I'd love some help with this. Roth conversions seem to make sense for me. I'd love to implement Roth conversions. I just don't know where to start, okay? This is what we do on a day in and day out basis. So if you're interested in learning more about how to work with our firm, you can visit our website at www.imaginefinancialsecurity.com, or you can start with the retirement readiness questionnaire that is linked in the description below. We're typically serving folks that are around the age of 60 that have at least 7 figures saved for retirement, and they want to minimize their lifetime tax bill, maximize their retirement spending, and worry less about the financial market. Up next, the video I'm going to plug is the tax trap of 401ks and IRAs, as well as how to identify your Roth conversion window. Until next week, I'll see you then.